Okay, so we're going on to learning objective number 4. We're going to prepare a bank reconciliation. The term reconciliation, to reconcile, it means literally to agree. And what we're looking when we're actually processing a bank reconciliation, in fact, many of you should know how to do this. This should be a routine for you. You should be doing this with your own personal bank accounts. In fact, when we were in high school, when I was a kid in high school, we had a class that would actually teach us how to reconcile our bank accounts. Now, I get it. You guys know what is in your bank account. You just log into your bank account on your cell phone and boom, you know what it is. But, without doing a bank reconciliation, you are at risk for certain things to happen. For example, bank errors. If a bank makes an error and you just assume that you're okay, then you may end up in a bad spot. Now, banks are pretty good. They most often catch their errors before that you even know about it. However, banks aren't perfect, and the only way you can confirm that you've caught something is if you've gone through the process of reconciliation. Okay, so to add to our internal control of our bank account, we're going to include signature cards so that when you submit these cards to the bank, they have a copy of what your signature should look like, which is authorizing specific individuals to access your account. You'll have a deposit ticket. The deposit ticket gives you the information you need to know about when you're making any deposit. A check is a physical document that shows the amount to whom it's being paid to and also has a mechanism for authorization. You'll have a bank statement. That's something that you'll receive typically on a monthly basis. And then you'll prepare what's referred to as a bank reconciliation. The signature card, bank requires each person authorized to sign on an account to provide a signature card, and it helps to protect against forgery. So they all have on record how a signature is supposed to look. And now, just a heads up, they don't really check it. But that's part of the reconciliation process. If something clears your bank account that never had your authorization, you can contest it. And so at that point in time, they'll look at a check that is cleared and what does the signature look like and compare it to their records, that signature card. And at that point in time, that will then confirm that you never authorized that transaction. So it helps protect against forgery. I'm going to suggest that it doesn't really protect against it. It helps you to recover from it after the fact. Deposit tickets. Banks apply standard deposit tickets. They give you something that allows you to add up the total amount that you're depositing so that you have a record of your deposit amount. And the customer fills out the deposit ticket and receives a receipt as proof of the transaction. So now on record, you have a deposit ticket that shows this is what you believe you deposited. And then when you get your bank statement, if there's any changes to that dollar amount, you'll be able to detect it. A check is written by various organizations. On the checks itself, it'll list the maker, the payee, the bank, and then obviously the amounts. The bank statement is something that arrives to you on a monthly basis, and it should summarize the dollar amounts that have come in and out of your account for that particular period of time. But it also will give you the detail you need in order to determine what checks have cleared, what electronic funds transfers have been made through your bank account, what deposits have been made in your bank account. So it gives you a lot of detail as well. It's sent to customers monthly. It reports customer cash activities, shows the beginning and ending balances, cash receipts, and cash payments. So anything that's occurred on your bank account, it should be on that bank statement to make your life easier to figure out. Here's an example of what a statement would look like. Here's First National Bank statement, and it is for Green Valley Coffee Company. This is the holder of the account, and it shows that their beginning balance was $6,550. their ending balance was $5,900. Those were the total deposits, the total withdrawals in total, and then you have the specific transactions listed. We're going to take that bank statement and create what's referred to as a bank reconciliation. And what we're going to be doing is that in almost all cases, you're going to find that what your records are in your general ledger, your set of books, your checkbook, whatever you're using to keep track of your cash, it should be the general ledger. Your general ledger should be updated for companies. If you're, as an individual, we don't keep general ledgers. We do have a check register, so that keeps track of our balance. They should be matching anyway. In a company, the register should be equal to what's on the general ledger. But in any event, from a company's perspective, we're making sure that what is written on the bank statement matches what's going through our general ledger account, our cash general ledger account, specifically the cash account. Now, in almost all cases, there's going to be differences. There's going to be differences between what is on this bank statement and what is actually listed on your general ledger. And there's a number of reasons that can explain those differences. That's exactly what the bank reconciliation attempts to do. It identifies the differences and reconciles the two so that when it's all said and done, you can show they in fact do agree. There's just some maybe time lagging differences or differences due to time lags in recording transactions. So in doing so, we're going to prepare a bank reconciliation where, in fact, we're going to have the bank side and we're going to have the book side. The bank side is simply going to look at what the bank statement says, and then from the bank statement, we're then going to adjust that account balance based upon what we call deposits in transit, outstanding checks, or bank errors. Let's talk about outstanding checks first. Outstanding checks will be easier for you to see. When you write a check out, even today, it's much faster than it's ever been in time. But even today, if you write a check out and you put it in an envelope and you mail it off to a place in New York, it may take a few days before that check that you wrote out on one day clears your bank. Now, right when you write that check out, you update your register. Right when a company issues a check, they update their general ledger. But if they wrote a check out on December 31st for $5,000, and that check doesn't clear the bank until January 5th, as an example, then when the bank sends the bank statement to the company, it's not going to include that check that was written on December 31st. It is considered to be an outstanding check. Well, that would explain why there's a difference between what you're showing on the books and what the bank is showing. Bank is showing you have more money. Well, why would they show they have more money? Well, the reason being is because that check that you wrote on December 31st hadn't cleared the bank as of the end of December 31st, assuming the bank statement is dated December 31st. So the statement itself has no record of that $5,000. So now you have something to reconcile to. Now you're saying, okay, that is a difference. That's why the bank says I have one thing, but my records say I have something else. So that's outstanding checks. Now, the same thing, and this seems a little bit more of a challenge for young people to understand, but that can also be the case for deposits in transit. Well, if you, let's say you're a retail store and you receive cash on December 31st, but you receive a few $1,000s after the banks close on December 31st. Let's say that's a Saturday night, and maybe you're closed on Sundays. So let's say it actually is on Friday night, December 31st, Friday night. You're closed on Saturday and you're closed on Sunday. You might even have Monday closed. Well, because of the holiday. So it may not be the first, second, third. It may not be till the third where that deposit is actually recorded by the bank into the account. There may be that kind of a lag time. When that happens, then your books are going to show that you made a deposit, and the bank is not going to show it on their records because they didn't record it to the day, the next day, or a couple days later. So deposits in transit is the same thing as outstanding checks, except we're talking about deposits. A deposit that's been recorded in your books, but it has not cleared or not been deposited per the bank. And then the bank can also make some errors. So these three items, deposits in transit, outstanding checks, and bank errors, would be adjustments that you have to make on the bank side of your reconciliation, because you're gonna break this up, and you'll see when we get there. You're gonna break a sheet of paper up into the bank side is gonna be one side, and then the book side is gonna be another. Okay. And so with that, then that would be on the bank. Those are the types of adjustments you would make on the bank side. On the book side, the kinds of adjustments you might make on the book side are bank collections. In other words, you didn't even know about, but the bank actually took in some money on your behalf. Maybe the electronic funds were actually made and you didn't even know about it, and the bank let you know, all right, through the statement. Electronic funds transfers, something that you haven't recorded that was processed, that may be something that you need to identify on the book side. A service charge that you didn't know about, you're going to record that. Interest revenue, you didn't know about that until you received the bank statement. Non-sufficient funds checks, if you've written out a check, or if you made a deposit, as an example, and those deposits came back non-sufficient funds, you had recorded them in your books as being deposits, but in fact they never actually materialized to being deposits. So you have less money than you thought you had. On occasion, the banks actually print your checks for you, and then they'll charge you a fee for that. And then you'll have what's called book errors, something that you've written incorrectly into the books, and that's manifesting itself when you're trying to reconcile. Okay, so here's an example of some information that you'll receive or that you will need to have so that you can complete a bank reconciliation. It's broken down here so it makes it pretty easy for you. But just like I mentioned to you in the previous slide, the bank side type of adjustments are going to be here. Deposits in transit, outstanding checks, and bank errors. So what you're going to do is on the bank side, you're going to list those types of adjustments that need to be made, and you're going to list them here on the bank side. And then these are going to be the types of adjustments that you're going to list on the book side. So let's go ahead, and I'll go ahead and put a spreadsheet up so that we can work through it together. So we'll call this Green Valley Coffee. Checking account. I think they're in more detail. We don't need that much detail. And we'll say this is December 31st, 2018. Let's be a little bit more specific here. Say this is okay, so we've identified the company, the type of report we're generating, which is a bank reconciliation for the checking account, and the date to which this applies. We're also creating two sections side by side. We have, on the left side, we have the bank, and then on the right side, we have the books. Okay, so let's go ahead and start with the bank. We're going to look at the balance for December 31st. And what we're going to do is we're going to actually go back to our bank statement. Here's the bank statement from First National Bank, and we're going to look at what was the ending balance for December 31st, 2018. It was $5,900. So that's what we're going to plot here. Oops. $5,900. From there, we're going to add 1, any deposits in transit, and 2, if there are any corrections of bank errors. Well, let's go back to our slide that shows all the reconciliations. The first thing it tells us is that there was a deposit in transit of $1,600. Specifically, that means that we recorded a deposit in our books that, for whatever reason, the bank is not showing it. Likely going to be a timing issue. Like I mentioned to you earlier, December 31st, they don't record it until the following day or a few days after the fact. Deposits in transit, $1,600. So we're going to go ahead and reference number one because that was the first thing. Number one, $1,600. That's going to be an addition. And the reason why we're going to add that to the bank is because the bank is too low. That money we've already received on our books. We know it's coming. We know it's here. The bank is going to recognize it, but they won't recognize it till the next month or the next statement. So we're not going to change our book balance. We know it's right. We just have to go and adjust the bank balance, recognizing that that's going to be something that'll be a timing issue. All right, let's go back. Number two, bank error. The bank deducted $100 for a check written by another company. So in other words, they pushed a check right through our account that they weren't supposed to. We noticed it when we were doing the reconciliations and said, hey, you can't do that. That's money. That's my money. You just took it away. So we'll call them. We'll get it squared away. But in the meantime, that adjustment isn't going to be fixed till the following statement. So we have to go in and fix it on here. So what was it? Bank deducted $100. We need to add $100 to the bank balance. So we're going to add $100. So at this point in time, we can go ahead and sum up what we have in total. And what we have in total so far is $1,600. Okay, but we're still not done adjusting the bank because there's going to be what we talked about earlier. There can be what we call outstanding checks. So at this point in time, we're going to go ahead and subtract outstanding checks. Just a reminder, these are checks that we actually wrote, that we issued out, that we've adjusted our books, our records, because that money is gone. We've paid that money out already. But for whatever reason, the bank hasn't received the check itself. So therefore, it's showing it as outstanding. Well, now on the records that we have a total outstanding checks of $1,340. Here's a listing of all the checks. Now, the slide is actually going to repeat this and write this all out individually. I'm not going to do it. I'm just going to list one line item that says outstanding checks of $1,340. So outstanding checks of $1,340. Here's my subtraction, $1,340. And so with that then, I'll go ahead and sum up what the bank really does have. And I have $6,620. We're going to refer to that as the adjusted bank balance. So we're halfway there. We figured out what's going on with the bank. They told us that we had $5,900, but we found out or figured out that there were some adjustments that needed to be made, including these three adjustments. After making those three adjustments, both adding and subtracting, we now have an adjusted balance of $6,260. All right, so now let's go over to the book side of the reconciliation, and we'll start with the balance as of December 31st. Now this is going to come from the books itself, and according to what I'm looking at, it's saying the balance is 3340. Okay, so this will be given. It'll have to be given in your homework. It'll tell you what. It'll either be given by showing you the ledger itself or give you the dollar amount. So the balance as of December 31st on our books, on our ledger account, is $3,340. From there, let's go ahead and make adjustments. First, we're going to add, let's see, number 4, EFT receipt of dividend revenue. Where do we get that from? Well, let's go look at the slide. It said number 4, EFT receipt of your dividend revenue earned on the investment, $900. This suggests that we didn't even know about this. We didn't even know about it until we actually received the bank statement. So it hadn't been recorded in the books. Because it hadn't been recorded in the books, we have to use that as a reconciliation. So we're going to add $900 to our book balance. Number 5, bank collection of your accounts receivable, $2,100. Same thing. We didn't even know that the bank had done that until we actually received the statement. So bank collection on account receivable. So they collected on our behalf $2,100. I guess they do through the debit card and credit card transactions. Number 6, interest revenue. They're saying interest revenue earned on your bank balance was $30. So we didn't know about it till we got our bank statement, so we need to add that, $30. Number 7, let's take a look at number 7. Book error. You recorded number 333 for $510. The amount you actually paid on your account was $150. So we recorded a check. That means we deducted from our bank account $510, and we only should have deducted $150. So that means we deducted too much. So the difference between $510 and $150, if you get your calculators out, you'll actually see that it is $360. And so we need to add that to our books because our books are incorrect. So we need to say book error for $360. So we need to adjust our bank balance up for $360. Sum this all up. What do we have so far before we start deducting everything? So before deductions, I have $6,730. Okay, so now we're going to look at those items that we're going to be subtracting. Number 8 says a bank service charge of $20. Let's go ahead and put that under number 8, $20. So we have less bank service charge of $20. We have number 9. It says NSF check from customer, $50. Subtract 50 from your book balance. In other words, we counted on money that we received from the customer, assuming that that was going to be a good deposit, and it turned out that it was not a good deposit. So we've got to go in and subtract the $50. And then we also have the EFT payment of insurance expense for $400. We must have forgotten about the $400 EFT, and now we need to adjust our books because of it. So that's $400. And we're going to sum up all of that we're going to subtract, or the less, of our book balance. The total is 2050 plus 400, it's 470. Now that we've got that in play, we can then identify this as our adjusted book balance. Let's make sure that we're subtracting the 470. 20 plus 50 plus 400 is 470, but it is a negative, so that's a less reduction. Now we'll go ahead and add it all up. So after making those adjustments to my book balance is showing that my balance is $6,260. My bank adjusted balance is showing $6,260. At this point in time, the two accounts, the bank and the books, are reconciled. What does that mean? They agree. This is what it looks like on the slide itself. Okay, so after we have the bank reconciliation, the book side is important to us because although we've identified things we had to do in order to adjust our balance, we haven't updated the books. We don't have to worry about the bank. That's all timing issues, and and this is a phone call. We'll call them and they'll fix it. But these book adjustments have to be entered into our accounting system. So in other words, 4, 5, 6, 7, 8, 9, and 10 have to all be entered into the accounting system. So that's going to be by journal entry. So for example, number 4, what was number 4? EFT, receipt of dividend revenue. So we received $900. That's going to be a debit to cash, and it's the offset is going to be to dividend revenue. That's going to be a credit. So on December 31st, number 4 is our reference. We're going to increase cash by $900, and we're going to credit dividend revenue. That's going to increase revenues by $900. Debit, credit, with the explanation here. Number 5, bank collection of accounts receivable. Well, that's just like if we received an accounts receivable in previous chapters when we booked it. That's going to be straightforward. Number 5, it's $2,100. So the debit's going to be to cash. That increases cash. And the credit's going to be to accounts receivable, $2,100, with the explanation. Transaction number 6, interest revenue earned on the bank balance. Well, that's going to be similar to number 4. We're going to increase cash by $30, but we're going to offset that to interest revenue, not dividend revenue, but interest revenue. So that's number 6, debit to cash for $30 and credit to interest revenue for $30. Number 7, correction of a book error. Looks like we needed to increase $360 to our cash account. Now here, they're not really giving us enough information. I think I know where they put it, probably accounts payable, yeah. So they're going to increase the cash for $360 because we had made an error in our cash account. And then we're going to credit accounts payable. We're going to add that back to accounts payable because we had entered that incorrectly. What this is suggesting is that when you first wrote the check out, you decreased cash and you debited or decreased accounts payable. So this, it reverses the amount for the error. Number 8, service charge. We're going to decrease cash by $20. We're going to decrease cash for $20, and we're going to charge that to service charge. So debit, oh, I guess they're just putting it against miscellaneous expense. $20, and they credit to cash. That's a reduction of cash. Non-sufficient funds, $50. This was from a customer, so we're going to reduce cash, and then we're going to increase accounts receivable. So the debit's going to go to accounts receivable for $50, and the credit's going to be to cash for $50. And then number 10, we have an EFT payment of insurance expense. Well, that's going to be a decrease to cash for $400, and then we're going to have to offset insurance expense. So number 10, insurance expense is debited for $400, and cash is credited for $400. So here's a summary of the various reconciling items. You can read through it. Here's an example of what the account history might look like.